Hey, Mark, good to see you. Today, I want to talk about a big looming question, which is, of course, whether the Fed's going to raise interest rates, especially if inflation and employment remain high, which they are. Usually, when we talk about inflation and unemployment, it's an inverse relationship. If we plot out that data on a graph, we'll see what's known as the Phillips curve, right? So, I want you just to explain, what is the Phillips curve, and is it even still relevant today?
Sure. Well, Phillips was an economist during the 1950s, and what he did was study 100 years of data based on the UK economy. And what he shows was inflation is highly related to unemployment, meaning
Hmm.
lower unemployment, you have higher inflation, meaning wage inflation, because there's fewer workers, so you have to compete for those workers. And this does a nice chart. This is the Phillips curve, actually. And it
Hmm.
shows you that the more unemployment that you have, the lower inflation pressures because there's more workers out there to hire.
Right, that makes sense. So inflation, though, still well above the Fed's target rate of 2%. Unemployment, as I said, still high. So which indicator are you keeping an eye on to determine whether the Fed is going to be raising borrowing costs?
Sure. And one point you were asking that I didn't address was, is it still
Is it
relevant?
relevant?
So it was relevant with the data that he discovered. However, since that time, a few things have taken place. Number one, 1971, getting off the gold standard. Well, that changed the whole entire complex of what inflation is, what monetary policy is, and how that works. In other words, how the economy works and how money works and how interest rate works and so forth and so on. So that is a big change. And for the last 20 plus years, there has not been a good correlation. The Phillips curve is really hasn't given the good indication. So it's a good foundational kind of economics 101 for students entering economics to understand, but then compare and contrast what the differences are. And then looking today, I'm looking at a very simple analysis, which is how is GDP growth addressing some of these supply disruptions? What's
Right.
happening in the economy? Because it's not just inflation that you're concerned about. It's inflation usually comes with an overheating economy, and what we're seeing right now is GDP growth start to slow. There's something from the Atlanta Fed who calculates a GDP now calculation. So it takes all the data interquarters where GDP is usually produced on a quarterly basis or released on a quarterly basis,
Hmm.
takes all that data incoming and it is showing a slowdown. And so we're firmly in a mid slowdown. We're seeing GDP growth well below 3% now in the twos. And I would make a point on inflation. There's two school of thoughts, monetarists and Keynesians. Monetarists believe that inflation always and everywhere is too much money chasing too few goods. Keynesians say that no, it's aggregate demand and the excess aggregate demand that's the problem with inflation. Today's problem is a supply chain disruption problem. And so that's not going to be really solved with increasing interest rates to slow down inflation. In fact, that would actually exacerbate the problem because it would slow down capital going to those areas that need to address the supply disruptions.
Hmm. So it sounds like you are keeping an eye on both of those indicators then, inflation and unemployment. But let's drill down a little bit more then into the inflation numbers. The personal consumption expenditures index rose 3.6% in August, which was the biggest jump that we've seen in 30 years. Is that significant?
Well, it is in the sense that you see activity in the economy and this strong rebound. So you do see those numbers higher. However, when you look at the details in the numbers, it's not as sustainable as you would think. A big contributor to those numbers was used autos, which actually was a 0.5% contributor, meaning a 0.5% up. So
Wow.
without used autos with an accelerating price because of the supply constraints in the auto market, you would have seen inflation much lower than it was. So it's not as big a concern. In fact, we see the energy complex showing upward price pressures, but that usually helps to slow down the economy from overheating. And again, I can't emphasize this enough that it's really supply disruptions that's the problem right now, not anything really having to do with interest rates. And so raising interest rates to slow down the economy will not solve the supply disruption issue, which is the root cause of today's inflation, which is different than wage inflation or some of those historical experiences with inflation.
Yeah, case in point, I ordered a couch back in July, Mark, which keeps getting delayed and delayed. Now they say it's going to be in January.
That's exactly the case that's unfolding.
It's very frustrating. My living room is not glad about it. All right, Mark, thank you very much.
Great. Thanks, Erin.